This is the Asia Trade. I'm Shery in Seoul.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Asian markets face heightened volatility after Wall Street wobbles. The S&P 500 moves away from the threshold of a bear market while Treasuries weakened. President Trump says he's not considering a pause on his sweeping tariffs plan as he threatens additional 50% duties on China. And Samsung Electronics' first quarter operating profit beats the street. CLSA will be with us to crunch those numbers.
We'll start you off with breaking news out of South Korea. We are getting the February current account surplus widening to $7.178 billion. When it comes to the goods trade surplus, also widening to $8.18 billion. Of course, we have been keeping a very close eye on South Korean exports, bellwether for global trade at a time when we have seen a lot of front-loading of these exports ahead of President Trump's tariffs. We're now seeing the current account surplus widening to that $7.12 billion US dollars. And of course, one of that big export story here in South Korea is Samsung. We're also getting the earnings out of Samsung. Their operating profit beating to the upside to 6.6 trillion won. We're talking about $4.5 billion. The estimate was around 5.7 trillion won. When it comes to sales, also a beat to 79 trillion won. We were expecting some weakness in that AI memory arena, but perhaps a lot of that strong demand when it comes to Galaxy S25 smartphones, not to mention legacy DRAM, might have offset some of those slipping margins from the AI sector to see first quarter operating profit also beat to 6.6 trillion won. And of course, we'll be awaiting their financial breakdown, divisional net income as well on April 30th. That announcement to come later in the month. But Samsung stock, of course, has seen a lot of downside in the past year, down about 30%. That's one stock that we'll be watching at the open in the South Korean markets. But take a look at how we're setting up with Asian futures looking like this after we saw the Nikkei fall to the lowest since October 2023. We're talking about the Japanese yen also falling a little bit against the US dollar. Of course, we have already seen significant strength in safe haven assets. We're seeing a little bit of that pullback in the Asian session. Sydney futures also looking to the upside of 0.8% as we continue to watch, of course, tariff news. We saw this whipsaw in the Wall Street session, Haidi, given some headlines around a potential pause coming on those tariffs. But of course, that did not happen. And we're now seeing also U.S. stocks being affected on the other side.
Whipsaw is really one way to characterise the wild swings, right, Shery, that we had in the overnight session where, of course, we had markets opening up weaker, significantly weaker and more volatile. A little bit of improvement when it comes to some news headlines that perhaps the tariffs will be delayed. However, that turned out to be fake news, according to the administration. Then we saw that sharp reversal. At the moment, though, after we saw the S&P 500 index finishing just 0.2% lower after a 4% plunge and a 3% rise, at the moment we're seeing yet more volatility as well. Nasdaq 100 futures, for example, extending their gain to 1% at the moment. If you take a look at volatility, though, that futures curve for the CBOE volatility index really indicating that vol may remain elevated for months to come. Contracts all the way out through to July trading at around 25. That is above that 10-year average of 19. So whichever way you cut it, it does appear that this sort of growth scare, the global growth scare, US growth scare brought along by these tariffs could be more seen as fundamentally driven than any kind of technical breakout there. Well, Bloomberg Intelligence says Trump's new tariffs are having a broader and more severe implications on the world's equity markets versus what was seen in 2018. The team's chief equity strategist, Gina Martin-Adams, joins us now. And Gina, we really appreciate you making time for us, given just how frenetic the market action has been. This is really kind of feeling like an existential threat for resentiment. Is today just a little bit of a breather and a chance to look at repricing with further volatility to come?
Yeah, I mean, I think that, first of all, it wasn't quite a breather in the U.S. session. It was a very volatile session, even though we did close down a little bit less than many had anticipated. It was still a very vicious swinging session, which is usually only affiliated with major corrective processes. in the S&P 500. The VIX spike that we've seen in recent days is also so much that it is now near levels where you would normally see very significant corrections in the index, usually affiliated with pretty major earnings recessions. So I do think that we've gone a pretty long ways to pricing in weakness, but we do have the first quarter earnings season coming in the S&P 500. That's the next hurdle for the index, and our models say that even though analysts have been really quickly marking down their expectations, it is likely that that season is going to disappoint even those expectations for the first quarter since 2020. So unfortunately, it does look like that VIX curve is right, that volatility is likely to remain, at least from a fundamental perspective. And normally when volatility is this high, whether you have upside or downside volatility, it's normally indicative of fairly significant earnings correction yet to come.
Gina, what are the implications for global markets? Because on the other side, we're also hearing speculation that China might ramp up its stimulus measures. Would that give a little bit of support, especially for those emerging markets that are so reliant on Beijing?
Yeah, the markets that are able to provide some degree of fiscal impulse are probably going to be some relative safe havens. It is normal to see as earnings crises emerge, the markets start to crave both fiscal and monetary supports. Unfortunately, in the U.S., we are not in a position to see a whole lot of fiscal support, with the exception of tax reform, which is so far looking to be more of the removal of greater downside risk rather than a real strong impulse, positive impulse for the equity market. With the exception of that, we're not likely to see a whole lot of fiscal support coming out of the U.S. because of the fiscal deficit situation. However, you do have the potential for greater fiscal support to come from a couple of key economies, such as China. Also, Germany really stands out as an area of potential fiscal spending boost coming this year that could offer some shelter from the storm in equity markets. The other impulse that you'd look for is monetary support, of course, and we just found out last week from Chairman Powell that there is really no interest from the Fed in coming to the rescue of the equity market, at least anytime soon. So we'll be waiting for some form of monetary support here, whereas monetary support may be more forthcoming in global equity markets. So I do think that broadly, the combination of fiscal and monetary support generally suggests that global equities are a little bit better positioned to weather this tariff environment than our U.S. stocks.
It's difficult to sort of conceive of the outcomes because the threat of these tariffs are so global and so wide-ranging, and the ramifications, are sort of very dependent on what happens with each country's transmission and as you say, some of the monetary and fiscal support that we see. But can history give us any guide in terms of what these periods of extreme volatility and sell-offs kind of can lead to technically?
Yeah, I mean, that's kind of what I was alluding to at the beginning. The history of the VIX would imply that you've got further weakness likely to come. I think a lot of investors right now are trying to price some sort of near-term sentiment bottom, and that may indeed be the case after such vicious declines that we've seen for the last several days in the U.S. equity market. But longer term, you very rarely see the first initial VIX close over 40 as indicative of the ultimate bottom in stocks. This is something we're working on right now, but for instance, when you saw the VIX spike above 40 in 2008, it was well in advance of the ultimate bottom in stocks coming in 2009. Quite similarly, the VIX spiked well above 40 in 2001. You didn't see the bottom emerge in stocks until close to 2003, so a couple of years later even. So usually what you see when these big VIX spikes are happening in an environment in which earnings are moving into distressed situations, you tend to see that more weakness emerges. In the short run, though, technically, we have gotten extremely oversold. We have seen some capitulation on the part of investors that could lead to something. The other thing I would watch is certainly pairwise correlations and valuations. Notably, the equity market valuation level is still sitting at 18 times earnings that are very questionable. So the true valuation level may be closer to 20 times earnings. Equities haven't bottomed above 16 times earnings since well before the tech bubble. So really tough to see a bottom coming because valuations have gotten so depressed. at least relative to recent history. And the other thing to watch is pairwise correlations. We do a 30-day rolling pairwise correlations measure within the S&P 500. That pairwise correlations measure has spiked to about just under 1 standard deviation above long-term average. You usually need to see that well north of 1, closer to 1.5 before major lows emerge. So you could get a near-term low, certainly because of sentiment, but the tea leaves that we're reading would suggest that you've got potential for a considerable amount of weakness ahead unless you get a pivot from policymakers.
Gina, is there any sector of the market that could potentially be protected from these wild swings? I'm talking about perhaps large, mid, or small caps. And if that makes any difference at all, given that exporters and importers are being hit at the same time?
Yeah, not particularly. Mid caps did show up as a better place in March and are slightly more sheltered from tariff risks than large caps or small caps. That said, there's not really a place to hide in terms of capitalization. It really becomes a question of beta and sector exposure. We tend to find that the stocks with the lower beta, the sectors with the lower beta to the broad market perform better in periods of distress. That would be things like utilities and consumer staples. We also tend to find estimate revisions much more stable for utilities in particular over time. This is the point in the cycle when utilities generally shine, is the point of maximum distress emerging. So you want to go lower beta in terms of sectors. Capitalization's probably not your best bet. That I would say. I will say though that small caps have gone a long way to at least getting closer to pricing recession with pretty suppressed valuations compared to large, but their beta is so very high. It's very difficult to get a lot of conviction that they're going to behave defensively. The other area that I would watch is countries with low betas. Countries like Saudi Arabia, for example, have very low beta relative to longer term other equity markets of the world. Also, China screens for us as somewhat low beta coming into 2025, particularly relative to its past. So there are pockets to hide in global equities, but when you're in distress like this, it's very difficult to expect a whole lot of upside to emerge in the short run.
Gina Martin-Adams, good to speak to you, Bloomberg Intelligence Chief Equity Strategist there. And of course, we saw a lot of that volatility coming from a social media post in the overnight session suggesting that Trump was perhaps considering a 90-day pause on the tariffs. Well, President Trump now saying that he isn't considering a pause on his plan to implement sweeping reciprocal tariffs on dozens of trading partners, but he's signaling he could be open to some negotiations. Bloomberg's White House reporter Skylar Woodhouse joins us now with the latest. So, Skylar, first of all, I guess no reprieve so far.
So far is the key word. I mean, it's still very early in these talks that we're seeing from the White House and with countries around the world. What we heard from President Trump today is, that countries are sort of lining up to negotiate with his administration. So it's only a matter of time until we see really what sort of the next step is in terms of what these tariffs are going to look like and if there will be any sort of, exemptions or bailouts or sort of reprieve for countries, sectors, all of those things. So, even though we've been hearing about this tariff talk for a long time, it's still in the early days. And given what we're seeing with the financial markets, the administration most likely will have to, address those financial concerns and start, ramping up those conversations with other countries as they look to sort of get some reprieve.
And, the opposite of reprieve, right? We had President Trump also threatening more tariffs on China, an additional 50% if Beijing doesn't respond favourably to his request to drop the reciprocal tariffs.
Yes, that's right. I think what we're seeing right now between President Trump and China is not necessarily a curveball. This was, we knew this was coming. We've seen countries sort of, push back against the U.S. President Trump campaigned on these tariffs, and he feels that, tariffs are going to bring jobs to the U.S., bring back factories and all of those things. But what we're seeing with China right now is not necessarily shocking, but it will be very interesting to see how the two leaders come together to sort of work this out as we sort of, border entering a full-blown trade war.
Yeah, and we're now starting to see some semblance of negotiations between leaders. Tell us a little bit about the reaction from the world, as we're also hearing from the U.S. that perhaps some countries will be prioritized in these negotiations, including Japan.
Yes, from what we know is, countries are sort of lining up to present their pitch to the administration. When you saw the list that the administration rolled out last week with all of the tariffs, I mean, you had some of the world's biggest countries, smallest countries, and so folks are really sort of trying to get in front of the administration to sort of hope that they can catch a break with these tariffs. I mean, Israel's Prime Minister Benjamin Netanyahu was at the White House today, and him and President Trump, they discussed tariffs. Israel was on the list to receive tariffs, and seems like they're making some progress in terms of working out a negotiation with how those tariffs will impact Israel. So yes, leaders are lining up left and right to sort of try and present their pitch to the administration.
Bloomberg's White House reporter Scarlett Woodhouse there with the latest. And we have also had other developments when it comes to a Supreme Court decision that is set to allow President Trump to use a wartime law to seek deportations. US Supreme Court deciding to allow Trump to resume deporting alleged Venezuelan gang members under the Alien Enemies Act in a 5-4 vote. It requires detainees to have an opportunity to challenge their removal in court before that deportation, but doesn't address broader concerns that many have been deported without a chance to argue their case. So we have already seen the Trump administration using that Alien Enemies Act to deport over 130 gang members to El Salvador, despite a lower court's order to halt that process. Well, coming up on the Asia Trade, we'll unpack Samsung's first quarter earnings with CLSA. We'll be talking markets and investment strategy amidst the volatility. Bokeh Capital Partners, as we see further upheaval from Trump's tariffs. Plus, discussing Australia's response to those duties with the Queensland University of Technology. Much more ahead. This is Bloomberg.
Samsung Electronics' quarterly profit beat expectations after strong demand for its Galaxy S25 smartphones and also legacy DRAM. They outpaced slipping margins from the AI sector as well. The company reported preliminary operating profit of $4.5 billion for the period versus the average estimate of $3.9 billion. Samsung's revenue also climbing to $53 billion. Joining us now here in the Seoul studio is Sanjeev Rana, head of Korea research at CLSA. Sanjeev, good to see you in person.
Great seeing you, Shery. Thanks for having me.
Of course. Let's dissect, first of all, the numbers. What do you make of them? I mean, it was a beat on both top and bottom line.
Right, yeah. So the results were much better than expected. So consensus was forecasting about 5.2 trillion won, but actually was about 6.6 trillion won. I believe the beat was driven by very strong performance at its semiconductor as well as the smartphones business.
When it comes to the semiconductor business, it's something that everybody's watching very closely, right? How are they setting up for the rest of the year?
Yeah, in 1Q, clearly they had this tailwind from inventory restocking by Chinese smartphone makers as well as PC makers and also demand from server customers there. So I believe that led to very strong shipments of DRAM and NAND. But as we move into second quarter, the focus will shift to how much price increases they will be able to negotiate with customers. The consensus expectations are that there will be some price increases on a blended basis. DRAM and NAND price declines appear to be moderating. We have seen the spot market, the DRAM spot price up about 15% from its bottom in late January. So this actually is a good setup for price negotiations with the major customers for 2Q and for the rest of the year.
And China has been a major customer, particularly in light of the struggles for certification with NVIDIA, right? How much, though, is that market sort of share of the pie shrinking?
Yes, so Samsung's issues with getting qualification from NVIDIA actually continues. So they are still in process of, getting qualification. Our expectation is that the qualification will probably come out sometime in late June, so that shipments can start in like July or August. But yeah, this has affected their HBM shipment volume expectations for the year. I think company's guidance at the start of the year was about 100% increase in the HBM bit shipments, but we think it's more likely to be in the range of about 60 to 70% max.
And Hynix, of course, in the meantime, has been pretty aggressively positioning itself as a primary provider of HBM4. Given the delays and the redesign, do you think Samsung can eventually play catch-up?
Yeah, that's what they have been trying for the last 18 months. So they have been playing catch up throughout, first for HBM3 and then HBM3E. Within HBM3E, like we had the 8-stack products and 12-stack products. So they continue to play catch up and haven't been able to supply meaningful volumes to NVIDIA. So as a result, their market share, we expect their market share in HBM to decline to about 30% range. Versus like a 35% plus last year. In HBM4, the meaningful shipments for HBM4 will start only in 2026, although Hynix is expecting qualification in the second half of this year, and same for Samsung. But our checks suggest that Hynix is ahead of Samsung and is most likely will maintain its dominant position within HBM market.
Given the challenges in this market, of course, we have been focusing also on their smartphone business. And right now we have seen some of their Galaxy S25, for example, have some solid results. But what do we see in terms of the tariffs having an impact? Because a lot of these devices are also made in Vietnam, home appliances, perhaps made in Mexico as well.
Right. So that's a big uncertainty. Clearly, this will have an impact. So about 25 to 30% of Samsung's revenue comes from US, and that includes smartphones as well as consumer electronic appliances such as TVs. In smartphones, nearly half of their production is based in Vietnam, where we saw big tariffs from the US. The company is looking to offset the impact of tariffs by diversifying its production bases. So they have smartphone production in India, in Korea, and a little bit in Indonesia and Brazil as well. So especially Brazil can be a good candidate given that the tariffs there are only about 10% or so. So the company is looking to diversify its production bases, but clearly these things take time. And Samsung, which has about 20% market share in the US. But if you look at the competitor Apple, they're also struggling with the same issues, and Apple has like almost 85 to 90% of its production for smartphones coming from China, where the effective tariffs are about 54%. So we think there is some possibility that if Samsung diversifies its production bases well, then they could gain some market share, not only from Apple, but also from some other brands, in the low to mid end.
Sanjeev, Rana, good to have you in our Seoul studio, head of Korea research at CLSA. And of course, we do have more ahead on the Asia trade. This is Bloomberg.
Take a look at how we're trading when it comes to Treasury futures, as well as watching broader volatility across US markets. We had Treasury markets experiencing a pretty big reversal from that safe haven bid on Friday. Yields soared higher, particularly on the long end. We do have coming Treasury supply this week and continued cross-asset volatility. So we're seeing rates markets and traders really cutting their value at risk there. We've also seen Fed rate cut bets being really quite volatile, and we're getting more of that volatility from Austin Goolsbee there, the Fed president from Chicago, speaking on CNN, saying that he sees, while hard eco data is still pretty good, that massive tariff retaliation could revive the picture of higher inflation. We've not seen a great deal of appetite from the Fed to step in at this point. More ahead on the Asia trade.
The two-year yield is screaming. I think it's screaming at the Fed. I think it's screaming at global central banks.
There is not an external pressure catalyst on President Trump right now to pull these tariffs back, and we should operate as though they are real and get over this idea of this being just a ploy. This is real, it is happening.
And the president's asking the American people for a long leash, and that's what's happening right now. And we'll see if the American people give it to him.
I do think it's going to be hard to avoid, further moves down in the market.
We went from stagflation in terms of people's thinking to recession in about 2 seconds.
I think tariffs are going up, and they're going to stay up for quite a long time. So it's not like a temporary supply disruption like we had during the COVID pandemic.
Some of our guests on Bloomberg TV following the recent market chaos triggered by President Trump's tariff policies. But take a look at how we're setting up for the market opens across Asia. Of course, we have seen that huge sell-off, a little bit of a clawback when it comes to those big swings that we saw in the overnight session. But of course, we're talking about the biggest swing, 7% intraday for the S&P 500, the biggest since 2020. Right now, we're seeing Nikkei futures pointing to the upside of more than 6%. Sydney futures also up 0.8%, all at a time when we're getting the latest lines coming all around tariffs. Prime Minister Ishiba now talking about tariffs posing a great concern over U.S.-Japan trade treaty, that U.S. tariffs are extremely regrettable, and that the broad tariffs from the U.S. will affect the global economy as well. Heidi.
Yeah, let's bring in for the market view Kim Forrest, CIO at Bokeh Capital Partners. And Kim, we were just talking earlier about how exhausted, I guess in a weird way, how invigorating this market has been, particularly over the past overnight session. We're now seeing US futures extending those gains. Certainly it appears that volatility is here to stay. Nobody knows much about anything when it comes to what's to come, right? How are you guys positioning?
Well, we're believe it or not, still doing what we do. And what we're trying to do is assemble a portfolio of stocks, depending on your risk level, to be able to outperform their peers over time. And with tariffs, there's going to be some winners and losers, but overall, if you've already identified a company that is outperforming its peers, has processes it to understand what its customers want, and is able to deliver that, I don't see a need to sell those companies. So we haven't been doing much other than making sure that our thesis is right and being ready to trade if we have to.
Everyone wants to know where the places are to hide at the moment, where you might see sort of that port in the storm. Are you being selective? Are you sort of becoming more international when it comes to the sort of more of the risks that we see for US assets right now?
Well, actually, most of the companies in the portfolio, even the smaller cap ones, we need to have market caps greater than $1 billion. So we have a kind of low threshold there, but not super low. Even our small caps have a lot of international exposure because they're probably operating in a niche market. So we already have that exposure, and I'm very happy to have that exposure at all times, but especially now.
Where are you adding right now, given, of course, the big losses that we've seen?
Sure. Well, I am checking out technology. Some of our newer accounts, we held off buying as tech marched higher, and I feel validated because I held off. It's always hard, whether the market's going up and you don't really want it to go up, or certainly no one wants it to go down like it has. But so yes, we're looking still in the semiconductor area. AI is still going to be big. It just is going to mutate over time.
There's been a lot of optimism over AI over in China. Of course, we have seen the problems right now when it comes to the potential trade war escalating from here. But is there any part in the Asian markets that you would be adding, considering, of course, the optimism around technology here as well?
Sure. Well, I think looking inwards to your exemplary companies would be where I would start. And again, you have a large population, unlike the U.S. We're a great consumer, but our population isn't as large as China or many places actually in Asia. So I would look to countries that can outperform their peers. That's a big topic for me, but that will give you growth over time. And and that are just at the top of their game, and kind of the consumer, whether it's a business or a retail kind of person, that they are willing to spend to buy that product. And that's what we're really looking for at all times, but especially in times of trouble.
You're now seeing President Trump threatening more China tariffs, potentially 50% additional tariffs if Beijing doesn't respond in the way that he wants it to. You're not forecasting a recession. That's not in your sort of realm of expectations. Why are you more optimistic than really a lot of Wall Street at the moment?
Well, I kind of I asked the big question in 2017 when the last tariffs were put in place between China and the U.S. And a lot of people on Wall Street were forecasting a recession there, pretty imminent as soon as the tariffs went in. And I don't think it was luck. I think it's something else that we never saw a recession during that time. Technology, I think, has played a huge part in this. Many companies, even really small ones, have very good sales systems, customer relationship management systems, and they can see their changes in demand for their products or services in real time. And I think that companies, married with the fact that they have good accounting systems that have been in place for many years, they can depend on these systems to be able to allow them to not order ahead too much or be able to ramp up whenever they see that demand returning. And I think that fine-tuning is what most companies are doing, so they're not doing that old trap of, going along happily until they find, the abyss of a recession where demand has dried up. So I think that real-time demand feathering about surging forward or pulling back should allow most of the world, in fact, to avoid a recession.
Kim Forrest, good to have you with us, CIO at Bokeh Capital Partners. And these are some of the other stories that we're following right now. JP Morgan CEO Jamie Dimon is urging a quick resolution to uncertainty sparked by President Trump's tariffs. He wrote in his annual shareholder letter that the quicker the issue is resolved, the better, as negative effects increase cumulatively over time and would be hard to reverse. Days after Trump won the U.S. election last year, Dimon said his tariff threats would get people to the table and that he hoped it would be done wisely. BlackRock's Larry Fink says most CEOs he talks to think the U.S. is already in a recession. Speaking at the Economic Club of New York, Fink added that he also foresees more of an economic slowdown in the coming months with elevated inflation and a weakening U.S. dollar. Despite the uncertainty, Fink believes that in the long run, the situation presents a buying opportunity.
Obviously, markets are down 20%. So some stocks are down over 30, 40% from their high water marks of just from January. But in the long run, I would say in the long run, this is more of a buying opportunity than a selling opportunity. That doesn't mean we can't fall another 20% from here too. But I do believe over the long run, the vitality of the United States will persist.
Wall Street lenders are postponing loans as investors shy away from risky transactions in the wake of President Trump's tariffs. Bloomberg has learned that at least 2 leveraged loan sales have been pushed to the sidelines in recent days. It involves funding for HIG Capital's purchase of Converge Technology and a dividend to ITG Communications owner Oaktree Capital Management as banks shy away from being left with hung debt. We have more ahead on the Asia trade. This is Bloomberg.
Well, President Trump is now threatening to impose extra 50% import taxes on China if it doesn't withdraw its planned retaliatory tariffs by April 8th. He's also threatened to terminate all talks with Beijing in an escalation of trade tensions. Let's bring our China correspondent Min Min Lo for more. So have we had much of a response from Beijing other than, of course, various measures to shore up the domestic economy in preparation for a trade war?
Well, not quite. We haven't heard anything in terms of concrete response, although we heard from the Chinese embassy in the U.S. saying that threatening and pressuring China really isn't the right way to engage with China, and that Beijing will continue to take measures to safeguard its legitimate rights and interests. And look, the way policy making goes in China is really in some ways the opposite of the U.S. And given that President Xi and China had just announced those retaliatory tariffs of 34% on Friday, it's very, very unlikely that they're going to reverse course just days later, even under U.S. pressure. We heard that from the Chinese embassy. Last night, President Xi was heard on the Chinese state TV broadcast in the evening, urging the country to fully unleash the consumption potential to spur growth. We know that policymakers had met over the weekend to discuss potentially front-loading stimulus policies, discussing measures to boost consumption, to boost the birth rate, to stabilize the stock market. We did see the national team yesterday stepping in to buy up ETFs and pledging to continue to do so in order to stabilize the capital markets there. And so a lot of China's attention, it seems now, is really to, quote, focus on doing its own thing. That's the title of the front page editorial on the People's Daily yesterday, while they brace for a prolonged standoff while still keeping that door for negotiations open, though. But it's just looking like that door, that gap is just becoming narrower and narrower.
And yet, you can see right next to you the charts of red when it comes to the Chinese markets. So how much can they really just step back and wait it out while we're seeing this huge plummeting of all Chinese assets at this point?
Yeah, I think a part of Chinese confidence is coming from the fact that they had prepared for this moment. They had the opportunity to learn from the first trade war. The economy is a lot more diversified. They are less reliant on both U.S. imports and exports. And according to sources, policymakers seem to have concluded that they do have enough arsenal at this point to tide through that market turmoil. But as you can see, yesterday was really a very, very bad day for Chinese markets. The Hang Seng saw the biggest losses since 1997, and overnight you look at what happened with the Nasdaq Golden Dragon, falling by about 5% or so, and it especially reflected in some of those big tech stocks, Alibaba, Baidu, PDD, falling between 5 and 10% or so. So today is really that deadline, right, for that ultimatum for China to remove those retaliatory tariffs, and if not, tomorrow those U.S. tariffs are going to kick in. So it is a day of peak tariff uncertainty. We might see another day of very, very volatile session in China today.
Bloomberg's China correspondent Min Lo there, and of course we're gearing up for the market opens in Japan as well, where we saw the Nikkei fall to the lowest level since 2023. Prime Minister Securities-Ishiba now saying that U.S. tariffs will have a great impact on the global economy and trading system. Bloomberg's Tokyo Bureau Chief Isabel Reynolds joins us now. Isabel, at least it seems that Japan is getting some priority when it comes to negotiating with the United States, because according to Washington, there's a long list of countries awaiting those talks.
Yes, that's right. Japan's Shigeru Ishiba did get a phone conversation with Donald Trump last night, at which they discussed how they would move forward on this. What Japan's preparing, Ishiba was talking about it in Parliament yesterday, is a big overall package.
Right, Isabel. I'm sorry, I think we are having some technical difficulties, but that was Bloomberg's Tokyo Bureau Chief Isabel Reynolds with the latest reaction when it comes to Japan. But we've also been hearing from action being taken by other Asian governments when it comes to President Trump's tariffs. South Korea is sending its Trade Minister Chung In-kyo to Washington this week for talks with U.S. Trade Representative Jameson Greer. The two-day visit will start on Tuesday. Seoul is facing a 25% levy, among the highest duties to be imposed on a U.S. security ally. President Trump has signaled he won't strike a deal to cut tariffs unless Seoul eliminates its trade deficit with the U.S. The Vietnamese Prime Minister is asking ministries and government agencies to work on Washington's concerns about non-tariff trade issues. The country is looking for ways to respond after the U.S. imposed 46% duties on its products. Authorities say Vietnam will push for more purchases of U.S. goods. So we have Tokyo Bureau Chief Isabel Reynolds back with us. But Isabel, we're talking about some of the preparations that Japan is making in order to deal with the tariffs coming from Washington.
That's right, yes. So Prime Minister Ishiba is looking at preparing a big overall package to sort of present to Trump. He's decided there's no point going for a piecemeal approach. And some of the things he's looking at putting into that package include investment in Alaskan LNG, for example, something about the car industry, we don't know exactly what, and then things on agriculture. Now, those are all very difficult things. For example, if you look at Alaskan LNG, normally speaking, it would be the private sector who would invest in that particular project. We don't know if private sector companies are interested in investing, frankly. If you look at cars, the current situation, Donald Trump frequently sort of complains that Japan is exporting millions of cars to the U.S. Well, the U.S. doesn't manage to export almost any at all to Japan, and that's perfectly true. But the reasons for that are more complex. There's no particular tariff on U.S. cars in Japan. The fact is that U.S. manufacturers are not necessarily producing the types of cars that Japanese consumers want. So how is that problem going to be resolved? One of the ways that it could be resolved is for Japanese makers, of course, to build more factories in the U.S. But can the Japanese government guarantee that that's going to happen? That's, again, a private sector issue. The one area where Japan does have, or the government does have power over this, is in agriculture. And there are still tariffs on foreign agricultural goods in Japan, particularly on rice, for example. Donald Trump has complained that there's a 700% tariff on rice. That's not quite right. There's more like a 200% tariff. But removing that would be extremely unpopular, I think, domestically in Japan. So there's a question over whether Ishiba would be prepared to sweep away those protections for the Japanese farmers in order to get rid of these tariffs for Japan.
Trump did say that he'd consider revising his tariff plans if he gets a, quote, phenomenal offer. So what's sort of on the table? What's potentially in that package?
Right. Well, the things I've mentioned just now are the things that are potentially inside the package. Whether they're deliverable or not is another matter. And frankly, even if Japan does manage to get the tariffs removed just for Japan, I mean, Japan is very much linked into the regional economy. If there's a huge tariff war, a trade war going on between the US and China, will Japan's economy, how badly will Japan's economy still be hit? That's a very big question. So just the bilateral ties on their own are not going to solve this issue. There's also the issue of public opinion. There was a poll at the weekend showing that most people in Japan favoured actually slapping retaliatory tariffs on the US. I think the Japanese public is a bit angry over the situation at the moment, and merely throwing Japanese money into this in order to get a better deal from the US, that might not be popular with the Japanese public, and it might not be good for Ishiba's own future.
When Prime Minister Ishiba took office, there was a lot of skepticism about whether he would have a good relationship with President Trump, especially given that the bar was set pretty high by former Prime Minister Shinzo Abe, who had this sort of, quote, bromance with President Trump, right? How has he done so far? And if he's able to actually pull off this tariff scenario in Japan's favor, how helpful could it be for his government?
Yes, well, I think in some respects the relationship between Abe and Trump was potentially exaggerated in some quarters. I mean, I think Abe did go a long way in terms of sort of complimenting Trump and trying to maintain that relationship by playing golf with him frequently and giving him gifts and that kind of thing. But I think we're dealing with a very different phenomenon in this second Trump administration. Trump is much freer to go ahead with the policies that he wants to do without being discouraged by more traditional policy types around him. So I think there's a big question about whether any particular leader could have made any difference in this scenario. So I think Ishiba's probably done as well as anyone could have expected. So we'll have to wait and see on what that means for his future. He does have an election to look forward to in July.
Bloomberg's Tokyo Bureau Chief Isabel Reynolds there with the latest from Japan. As we're also getting breaking news, we're getting the Japan current account balance, and we're seeing a surplus coming in of more than 4 trillion yen, which is above economists' expectations of 3.8 trillion yen. Adjusted current account surplus at 2.3 trillion yen. This is for the month of February. Of course, we have seen a lot of front loading when it comes to some of those exports and goods sent overseas ahead of what was expected to come from Washington in terms of those tariffs. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how we're tracking when it comes to US futures, and that bounce that we're seeing is really playing up. But of course, volatility has just been surging in the previous session, and that is expected to continue unabated. At the moment, you're seeing S&P futures as well as Nasdaq futures extending beyond 1% to the upside. Dow Jones futures also up by 1.3%. But that futures curve when it comes to the VIX really indicating that volatility could remain stretched and elevated for months. Contracts out all the way through to July, trading at around 25. That 10-year average is about 19. So this kind of broader global growth scare that's been brought on by these tariffs from President Trump seems to be more fundamentally driven, according to analysts, and perhaps more worrisome than the breakout that we saw in the VIX last year as well. So that move may not fade quite as quickly. But at the moment, we're seeing after, of course, what was just truly a whipsaw session in the overnight session on Wall Street, dramatic, really moving on this news flow, the sort of potential rumours over when it comes to a delay on tariffs that then was denied by the White House, and we saw lots of oscillations there. That turbulence, of course, expected now to spill over to the Asian session as well, even as we have a number of futures in Asia sitting to the upside. We are getting some reporting from the Washington Post saying that Elon Musk made personal appeals to President Trump when it comes to tariffs. So hearing that there's a number of President Trump's billionaire backers that are beginning to really bulk at these tariffs, particularly those that have placed heavy bets on this presidency, Shery.
And we're seeing more countries really trying to support their own economies in order to counter the effects of the tariffs, right? We're hearing from South Korea that they're now going to announce a 10 trillion won extra budget plan early next week, and that 3 to 4 trillion won of that budget plan will be in actually to respond to these tariff threats, also to invest in artificial intelligence. They'll also be investing about 3 to 4 trillion won in supporting small businesses. We have seen, of course, the Kospi take a hit. ICE at the lowest level since 2023, although futures are now pointing to the upside, as well as Nikkei futures up more than 5%. The Nikkei also at the lowest level since 2023, as we heard from Prime Minister Ishiba as well, that the tariffs will pose great concerns and they're extremely regrettable for the Japanese economy. We have the market opens in Sydney, Seoul, and Tokyo next. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens. We saw some big volatility in the overnight session. 7% intraday swing, Haidi. We're talking about the biggest since COVID in 2020. We're seeing a little bit of upside for Asian futures, though.
Yeah, even if this is a repricing, perhaps we are just seeing a little bit of a breath being taken, and we could see that positive lead into Asia. If you take a look at VIX futures, Shery, does look like that volatility will remain extended, particularly as we get more news flow from the White House, right? President Trump now threatening an additional 50% tariffs on China if Beijing doesn't respond by his deadline this week to drop those retaliatory tariffs, and it doesn't look like we're going to get that sentiment really from China.
Yeah, we've already seen Chinese stocks plummet, of course, and we're now setting up for the market opens in Japan and Korea. The Nikkei up about 2% at the open right now. This, of course, after falling to the lowest level since 2023 already. We're seeing a little bit of strength for the Japanese yen, but after weakening in the overnight session, we had seen the greenback also gain ground in the previous session. We're watching those JGB yields very closely. Of course, we have seen them plummet to new lows that we haven't seen since January. Really, the global bond rally has been a key theme overnight as well. But we heard from Prime Minister Ishiba talking about these tariff concerns, that they're extremely regrettable. And of course, pointing out that cars are a pillar for the Japanese economy. We'll be watching those Japanese car makers in today's trading session as well. Take a look at how South Korea is trading as well. We've gotten some current account data, both from Japan and South Korea. When it comes to Japan, we saw a surplus as well. For Korea, we also saw another surplus widening to more than $7 billion. We also heard that South Korea will be announcing a 10 trillion won extra budget plan early next week. Of course, a big chunk of it will be in response to the trade issues right now around U.S. tariffs. We also had Samsung Electronics, you can see right there at the open, gaining about 3%. They surprised to the upside on both top line and bottom line. We're talking about operating profit coming in at $4.5 billion, Heidi.
Take a look at how we're shaping up when it comes to this staggered start that we see in Australia. We are seeing a little bit of upside at the moment, about 0.2% higher there. Of course, here we're seeing investors really betting bigger when it comes to both the rate cuts from the RBA and RBNZ. There now really calls for 50 basis points in the RBA's next decision. The Aussie dollar at the moment, we're seeing downside under that 60 US cents as that continues to play out as both a risk-averse proxy for the US as well as to the secondary growth impact that we see out of China there as well, right? When it comes to the bond space, we're seeing Aussie bonds sliding along with New Zealand debt as well after that sell-off in treasuries. That debt volatility gauge in the US hitting the highest since late 2023. So we're seeing that again on the 3-year here in Australia, that note jumping, the yield on that note, I should say, jumping 16 basis points, a 10-year surging 21 basis points. We do also have at the bottom of this hour consumer and business confidence data from out of Australia as well. So we'll be watching that, particularly as Shery, of course, there's so much focus on what these flow-on effects of Trump's tariffs will be on individual domestic economies.
Yeah, joining us to discuss everything is Peter S. Kim, Head of Global Business Group and Investment Strategist at KB Securities. Peter, really good to have you here in our New Seoul studio. Give us a little bit of your reaction so far to what the markets are doing, because it seems, at least for today's session, we could see some upside.
I hope that there's going to be some sort of relief in the investor sentiment. But as you know, I don't think we've progressed any further in terms of getting clarity on where this trade negotiation lies. I think the market's been very surprised by the intensity and the scale of the trade war and weaponizing of it, and how it's going to spread to individual countries and from a both economic and political front.
So you expect more market pressure right now, given, of course, that we don't have a resolution, especially if the tariffs against China right now with the ultimatum coming from Washington as well, just this war could escalate. Are we expecting to see just more tit for tat that could depress stock prices here across Asia?
I think as far as U.S. and China goes, we are well and truly into the game of chicken. Trump has made his move and China has retaliated rather than choosing the path of compromise. And it's now up to which country is going to blink first. And that's very dangerous. And that's certainly, I think, probably right now biggest concern for Asia.
On the other hand, if you see Beijing perhaps coming out with the stimulus measures, that boost, could that help support other markets like South Korea?
Potentially. I think in the background, China actually have quietly gained some ascendancy over the past couple of months, both in terms of domestic economy, but also if you look at the actual tariff that's been imposed by the U.S., China has come out okay, 34% relative to Vietnam's 48%. Korea's 25%. I mean, given all the banter and threats that we've seen from Trump for the past few months, China seemed to have come out okay. And remember what happened during subprime crisis. Just when the U.S. was under pressure and the whole economy was seeking a way downside, China made its big stimulus move and really rose above the rest of the world. And maybe we might see a little bit of that replay.
We're seeing Japan's Topix index rising more than 3%, really reflecting on what was a volatile session that we saw in the overnight trade on Wall Street. I wanted to get further views on China, though. Does that mean you see Chinese equities as a pretty strong diversifier, at least in the longer term, if you have the stomach for the volatility in the shorter term? And if so, which parts of that market are you still sort of keen on some of the momentum that we've seen in tech and AI, for example?
Sure. I mean, I think just within a couple of months, we've seen investment sentiment really turn positive away from the U.S. to China. I think that was sparked by the DeepSeek revelation. But also, I think the Chinese government realizes that they have to come out of this sentiment rut, both in terms of corporate investments and consumer spending. That has really changed the narrative now. And perhaps the domestic stimulus is just the foundation which China can really build upon over the next 6 to 12 months.
It's funny you talk about the underappreciation of President Trump to be able to reach his political objectives. Of course, so much of these strategies have been pretty unorthodox. Does that mean even if some agreements get done on the tariff side, particularly on the bilateral side, given that we're seeing conversations happening between Japan and the US, for example, investors should still be bracing for more unconventional policy to try and achieve those objectives?
I believe the structure of the reciprocal tariffs, the fact that it targeted trade deficit rather than actual tariffs, as well as the fact that they have now mixed in a lot of other non-economic agenda into the conversation, will ensure that we will have this trade war prolonged. Whether individual countries come to a resolution quicker than the others is probably the question. And I think the biggest uncertainty for the markets is that where are we in the game? Are we in the first quarter or are we in the last quarter? Investors wanted to think that they think that we might be in the final quarter, but I think, to be honest, we might be looking at first or second quarter at best.
What about for Korean stocks, especially at a time when, of course, we still don't have some clarity on what the new government will look like?
That's right. South Korea, just at a time when we need leadership, we have these domestic issues we have to clear up. Fortunately, within the next 60 days, we will have a re-election, and hopefully that will anchor the political situation. And also, we had a little bit of a positive on the short sale ban being lifted. And as long as that doesn't come back in the near future, that's probably a decent foundation for the Korean equities to start to maybe outperform.
Peter S. Kim, good to have you with us. You're in our New Seoul studio, head of Global Business Group and investment strategist at KB Securities. As we continue to follow some of these names across Asia, some of those big moves around Hanwha Aerospace, for example, is now gaining 7.5%, and this on news of reducing their stock offering size to 2.3 trillion won versus an original 3.6 trillion won. They're also seeing an operating profit of 3 trillion won and 30 trillion won sales for this year, according to regulatory filing. We're also watching Nippon Steel because they were looking like they could gain ground. President Trump has ordered another review of their takeover bid for U.S. Steel. In early trade, we saw some of those bids for Nippon Steel at numbering offers by a ratio of more than 2-to-1. Of course, this will have really big implications when it comes to that transaction and that merger that could amount to more than $14 billion. Trump now directing CFIUS, the Committee on Foreign Investment in the U.S., to submit a report within 45 days. All of this coming at a time when we're also hearing from Prime Minister Ishiba that he spoke with Japan, with President Trump, and talked about the cars in the Japanese market being a pillar of the Japanese economy. So we're watching some of those stocks in focus. Hyundai Motor here in South Korea under pressure, though.
Yeah, it'll be very interesting to watch some of these sector-specific stocks that have been under so much pressure for Japan. Right, if you take a look at some of the gains that we're seeing, a bit of a relief rally. The question is how sustainable this is going to be. Toyota, of course, up by one of the market leaders at the moment, as well as Mazda Motors, up by 8.5% there. But these sweeping tariffs have really cast this dark cloud over Japanese automakers. Some of them more vulnerable than others. Nissan, for example, facing potentially the biggest hit. And of course, we know the US is the biggest market for these big five main car makers for Japan. For Toyota, it's about 23% of global sales last year, 28% for Nissan, 71% for Subaru. So any kind of potential optimism over US-Japan trade talks that could provide an alleviation of pressure, clearly welcomed by this market. But I should mention this is taking place in an environment where, of course, we're seeing broader gains there at the moment. The Nikkei 225 up by 5%. Topix also higher by over 5% so far this morning. More ahead on the Asia trade. This is Bloomberg.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals, and in certain cases they're going to be paying substantial tariffs.
President Trump telling reporters that he isn't considering a pause on his plan to implement sweeping reciprocal tariffs on dozens of trading partners. For more, Bloomberg News Desk editor Jill Deasis and our China correspondent Min Lo joins us now. And Jill, that really rebuking of the tariff pause rumour that, of course, caused so much volatility in overnight markets, and then a further ultimatum to China of the threat of additional 50% tariffs. There's a lot going on.
Yes, there is, Heidi. And what this kind of comes down to is this confusion over whether Trump is actually open to negotiations or not on some of these tariffs, and what that would ultimately mean. Is he open to negotiations on some of those higher reciprocal tariffs that go into effect Wednesday? Is there no agreements or any kind of baseline understanding that he would remove that 10% tariff that went into effect over the weekend? Again, lots of confusion flying around. But as we just heard from the president himself, obviously these tariffs, he says, are here to stay. But then we kind of see, where this comes in with, conversations that he's having with other world leaders. He obviously was just speaking on Monday with the Israel Prime Minister, Bibi Netanyahu, not giving them a lot of leeway, despite the fact that Israel is a close U.S. ally. They were hit with a tariff. Obviously, you're hearing, this move on China, maybe due to a lot of the reciprocal measures, those retaliatory efforts that China put in over the weekend, that they announced that matching 34% tariff on American goods. That's what's leading him to threaten there. So again, yes, lots of pieces here. But I think the bottom line is that clearly Trump is willing to play hardball when he feels that these countries aren't cooperating. Now, whether they come around and really sort of beg and plead to negotiate or whatever it is that, Trump is thinking, would want to position themselves, maybe that's something that he's more open to. But again, really, really difficult to tell at this point.
Yeah, hardball, especially against China, now threatening an additional 50% tariffs. But Beijing seems to be defiant.
Yeah, I mean, look, the additional 50% tariffs would bring the total tariffs on Chinese goods to over 150% and essentially pretty much just decimate all bilateral trade between the two countries. And as of yesterday, even before Trump had retaliated with the additional 50%, it does seem like China already harbors no sort of illusions that there could be a trade deal with China. This was specifically stated in a state media editorial on the front page of the People's Daily yesterday. They're taking no chances, and that's why all of China's efforts now, it appears to be to bolster the economy, to really ring fence it from the risks of these external shocks. And you have the likes of Morgan Stanley saying that we could maybe see China roll out a series of stimulus. We know that policymakers have been discussing over the weekend whether to front load the stimulus this year. Some of those measures could maybe look like maybe expanding that equipment subsidy program to include consumption subsidies for more goods and services. Triple R cuts, interest rate cuts could be imminent. That was flagged by the People's Daily piece as well. Morgan Stanley expecting that maybe China could even expand the fiscal deficit in the second half of the year. So the next date in the calendar we want to circle for China is the April Politburo meeting, when policymakers will be meeting to discuss what to do about the economy. That could be a potential window for more policy adjustments. But so far, we have heard from the U.S. embassy, from the Chinese embassy in the U.S., saying that threatening and pressuring China really isn't the right way to engage with China, and that China will continue to take measures to protect its legitimate rights and interests.
Min Min, we've also spoken to a number of people that still see China stocks, China risk assets as being a good diversifier away from the US. Of course, we had a pretty severe bout of panic selling. Is that likely to be extended?
Well, it's really hard to say, right? Because today is the deadline for that ultimatum, and tomorrow the tariffs are supposed to kick in. So anything could happen today, and it could be a very volatile session again. But we have seen over the past year or so, Chinese and U.S. stocks moving in different directions. Certainly, Hong Kong stocks have been rallying a lot year to date so far, and so that is why we are seeing it having a big hit as well. Because if there's any place you want to withdraw liquidity from the market, Hong Kong is the first place where there is a lot of profits to take so far this year, and that's why we saw it being hammered yesterday. The Hang Seng sliding by the most since 1997, but we'll have to see. We did see onshore stocks sliding to a smaller extent than offshore, and that could be because the Chinese national team, some of the state-backed, state-owned sovereign funds stepping in to buy up ETFs. They have pledged to continue doing so to put a floor on markets there. So yes, we do see maybe onshore investors a little bit more optimistic than offshore investors that are really offloading a lot of their China positions at this point.
Right, Bloomberg's China correspondent Min Min Lo, as well as Jill Deasy, is there joining us with the latest on those tariff news as we continue to hear from business leaders as well weighing in on these Trump tariffs. We have Citadel Ken Griffin now talking about how the tariffs will tax the middle class. That's a huge policy mistake. He does acknowledge that President Trump is spot on that global playing field is uneven for the U.S., but he fears that the U.S. is abdicating the leadership of the free world. You can see U.S. futures now gaining 1.4% as we're seeing NASDAQ 100 futures also reversing some of those losses that we saw early in the overnight session to gain 1.5%. So Citadel's Ken Griffin just adding to the chorus of business leaders also weighing in. We just heard from Elon Musk that potentially he had made some direct appeals to President Trump to reverse the sweeping new tariffs, according to people speaking to Bloomberg. Jamie Dimon also has said publicly that it may be disastrous in the long run. This is Bloomberg.
Well, New Delhi has so far held back from taking retaliatory action against the US for imposing 26% tariffs on imports from India. The Commerce Minister, Piyush Goyal, speaking to us at the India Global Forum, downplayed the impact of tariffs on the relationship between India and the US.
We all know that it's a formula-based tariff, and based on that formula, friend or foe, everybody fit into that formula and had a tariff imposed on them. So it's nothing to do with the fact that we are friends. Clearly, Prime Minister Modi and President Trump are very good friends, as are the administrations of the US and India, and as are the business persons and people of the two countries. So I think let's not conflate issues. There's nothing to do with, for that matter, UK is a very good friend, US is EU is very good friends all over. But I think this is just a formula-based tariff.
So are you in conversations? Are you hoping that perhaps you'll get an exemption or perhaps a delay in the implementation?
Well, I think what we discuss in the boardroom is not discussed in a public forum.
But you are in conversations then?
That is a matter of public record. I think when the Prime Minister and President Trump met in February, they had both announced that we shall enter into discussions for a bilateral trade agreement by the fall of 25. Both countries are old friends, old allies, trusted partners. Our businesses work seamlessly with each other. India opened their arms to all the tech giants, be it Google, be it Meta. All of them were welcome in India, even when many other developed countries, and certainly China, did not allow them to operate in their countries. We have hundreds of thousands of students in the United States. We have a strategic partnership which transcends the economy. So there's lots that we are working together on. This will also be something that will add luster to our relationship.
So that trade deal is coming, and you're confident it will happen by year end, including the other trade deals that you're working on, including the UK as well as Europe, which you have just indicated are friends.
You know, I'm not going to give Bloomberg a headline.
Put this in perspective for us. With what's going on right now, are we at the start of deglobalization? We've been throwing this word deglobalization for a while now.
I don't think so. I think this is reglobalization with honest terms of trade and countries which believe in the rule of law, like India, working in partnership with like nations who also would like to have an orderly framework. In the short run, there could be some turmoil, but as I mentioned earlier, India believes in converting every crisis into an opportunity.
So how do you seize the opportunities? What opportunities do you see? How does India play a bigger role in the shifting supply chains?
Ms. Amin, we are a democracy. We believe in the rule of law. There's fair play. We don't discriminate between Indian or foreign investment. All are welcome. The rules of the game are equal. Everything we do is transparent, and we have a very, very independent judiciary and ferociously ruthless media. And add to that the social media now. Unforgiving. So obviously in India, we offer a conducive environment.
Indian Commerce Minister Piyush Goyal speaking with Bloomberg Insight anchor Hasinda Amin in Mumbai. Take a look at how Japanese assets are trading at the moment. Of course, we are seeing the repercussions of those U.S. tariffs. A little bit of a rebound in today's session as we're hearing from local media that Prime Minister Shigeru Ishiba will appoint Economic Revitalization Minister Ryosei Akazawa to lead tariff negotiations with the U.S. Akazawa has already commented that he must work on tariff response for Japan's best interest, as he's agreeing with Prime Minister Ishiba tariffs seen as national crisis for Japan. This is we're seeing the Topix Bank Index also gaining ground. We are seeing a lot of those losses in JGBs in today's session, leading to yields higher. Nomura, one of those financial institutions that's gaining ground, Haidi.
Yeah, certainly the bilateral talks that are perhaps happening between Japan and the US seeing a little bit more optimism when it comes to the recovery in the Japanese session. We are looking like a little bit of upside when it comes to the start of trading in Europe as well, after we saw some pretty big swings that sent European stocks to that one-year low, as we saw that threat of the 50% additional tariff on China coming through there. We saw the stocks Europe 600 falling 4.5% to the lowest level since the end of February in 2024. But perhaps we'll see a little bit of a rebound in this session. More ahead on the Asia trade. This is Bloomberg. Take a look at data that's just crossing the Bloomberg when it comes to consumer confidence readings in Australia. It was a pretty big miss there when it comes to that seasonally adjusted month-on-month Westpac consumer confidence reading for April, contraction of 6%. The prior reading was for 4%. Consumer confidence index on a year-on-year basis for April, sitting at 90.1 actually is the reading, falling from 95.9. So some concerns that would be passing through when it comes to the RBA, which now is really under pressure to move faster. In fact, Treasurer Jim Chalmers over the last 24 hours signalling the possibility of 4 RBA rate cuts this year, which markets are already pricing in, but certainly the sweeping tariffs, the 10% tariffs for Australia, even as a key ally and trade partner of the US, have now dented sentiment and are calling into question whether the RBA can afford to be as cautious as it signalled that it wants to be. We've also seen that big move when it comes to the Aussie dollar operating as a risk proxy, falling under that 60 US cent level at the moment, just above 60 US cents. We're seeing a little bit of a gain, although muted compared to some of the other equity gains that we've seen in this session. Taking a look at those yield plays as well as we follow the move that we saw in Treasuries lower as well, with some of that haven appeal just sliding a bit. Take a look at broader Asia markets, and really the standout has been Japan, and that's really on this theme of perhaps we can start to see some progress being made on bilateral trade talks, as we hear that potentially Japan and the US are in and about to start sort of negotiations of what could be done when it comes to these trade threats. President Trump has signalled that he could be open to some negotiations if there is a phenomenal offer. We are seeing some pretty solid gains across the Nikkei 225, the Topix as well, over 5%. The Kospi also seeing a little bit of upside there. Some good numbers out of Samsung would be helping along that as the heavy weighted stock there. And Australia just putting on about 1%, Shery.
Yeah, tech stocks really leading the gains here in the Kospi, and we're seeing, as you mentioned, Samsung Electronics also gaining ground. Quarterly profit at Samsung beating expectations after strong demand for its Galaxy smartphones as well as legacy DRAM. For more, let's bring in senior tech reporter Yulim Lee and Asia stocks reporter Yu Young Lee as well. Yulim, let me start with you. What did we see in terms of performance? It was surprising to see the upside beat in both top and bottom line.
Exactly. Samsung has been predicting very, very weak quarter since the last quarter. But the company has not disclosed the divisional performance yet. They will do so at the end of the month. But, the checks with the sources has suggested that it's really driven by strong sales of smartphones. The Galaxy S25, which is their flagship phone, was launched in January, and it's done really better than expected. And then it's also attributed to the stronger than expected revenue at the memory business, which is really, I think the high density memory chips, which is used in servers. There was a really strong demand from China as well as the legacy DRAMs.
And perhaps that's optimism being felt across investors as well, because we've seen a little bit more upside for Samsung, which has been really battered over the past 1 year.
Yeah, that's exactly right. So the year 2024 was a pretty miserable year for Samsung investors. It was one of the worst performer in the chip space globally. But if you look at 2025, surprisingly, Samsung is one of the outperformer in terms of the share price. And that comes not because it has been able to catch up with this technology leadership with SK Hynix or gain this deal with NVIDIA, but because what Samsung has been doing well, which is the commodity DRAM, the cheap space, the cheap DRAM is seeing the rebound in demand. And just as earlier, Yuling pointed, we're seeing some demand recovery from China after DeepSeek. And we're also seeing some demand possibly coming from clients trying to stock up inventory ahead of the potential tariffs from the United States. So we'll see where this demand is really coming from after this first quarter, but there certainly is the uptick in demand that investors are pinning their hopes on.
Yeah, Yuliam, as Yugon just mentioned, I mean, it could be a lot of the front loading happening right now, right? Because people were expecting these tariffs to come from the U.S. I guess at this point, can we tell how much was that? And also how much was the optimism perhaps about what happens with these advanced chips? Because Samsung has been trying to catch up to SK Hynix. How far along are they?
Right. So you're absolutely right. There has been a lot of front loading. We're hearing, I mean, we don't know exactly. We don't have the exact figures yet. We don't have the details as of now. But what we're hearing is that a lot of demand from Chinese clients. They are expecting, obviously, the tariff, measures to kick in. So they were ordering a lot of, volumes from Samsung, which was a surprise to the company as well as I think DeepSeek, as Yu-Kyung mentioned. It really proves that you don't need to have the top end, most advanced chips in order to really have this new generative AI servicing products. So a lot of demands are coming in because of that. In terms of HBM, high bandwidth memory chips, which is really the crucial, most lucrative product right now in the memory business. The U.S. Government has imposed a lot of restrictions at the end of last year to really limit Samsung's supply to Chinese customers. So that really triggered the company to, tell to the market that first quarter is not going to be good. So because I think there's this vacuum of orders, so obviously I think there is this new DRAM and high density chips server clients that are really making up the loss.
So just quickly, Yu-Kyung, then how are we seeing chip stocks stack up to Samsung, for example, across South Korea? Are we seeing a little bit more of that optimism?
So Samsung is seeing one of the more attention from investor, and that's because we're expecting the earnings beat in the first quarter, and also because of the recovery in the market for the conventional DRAM, and also to a certain extent in this area of at this time of high volatility, Samsung is the kind of shares that offers some kind of stability to investor with the lesser of the high beta. So I think that's why we're going to see a lot more attention coming from investors on Samsung for a while.
Yeah, a lot of comfort when it comes to market volatility overall, investing in these big stocks. Bloomberg's Yu-Kyung Lee and Yu-Lim Lee here joining me with a reaction to Samsung's earnings today. Heidi.
Yeah, Shery, take a look at one stock that we're watching very closely in terms of being an outsized move, and that is Nippon Steel, trading so far in the Tokyo session up by 9.5% against broader gains of around 5-6% when it comes to broader markets in Japan. This boost coming after President Trump ordered a review of the potential sale of United States Steel to Nippon Steel. We could amend a decision by his predecessor to block that $14.1 billion transaction. Trump has directed the Committee on Foreign Investment in the US to submit that report within 45 days to determine whether more action is appropriate. So that really kind of injects a bit of hope into this deal that was previously blocked and really considered to be a bit hopeless. But of course, this is a transaction that is heavily politicized. Advocates arguing that would revitalize US steel, and opponents, including the Steelworkers Union in the United States, resisting that takeover. So we could see further developments, but certainly a big move there for Nippon Steel. We saw US Steel shares surging about 15% after the announcement, and actually triggered circuit breakers and halted trading briefly as well. More ahead on the Asia trade. This is Bloomberg. Australian Prime Minister Anthony Albanese and opposition leader Peter Dutton are set to present their vision for the country in their first televised debate on Tuesday. This takes place against the backdrop of a global trade war that's caused wild swings in global markets. Our government reporter Ben Westcott is in Canberra for us and joins us now. And so, given all of the global oscillations right at the moment, not to mention domestic challenges, what are we expecting?
Yes, it's going to be an odd campaign for Australia. Often international factors don't play so much into Australian campaigns, but this has probably been the most influenced since the 2001 election, which took place just after the September 11 terrorist attacks. So yeah, basically we're expecting a big night for the two leaders. This is a real make or break moment for opposition leader Peter Dutton, who's had a very rough start to the campaign. He's recently announced that he will be backtracking on his policy to make government workers work from home, Trump-style policy that was very popular when he announced it and now is very unpopular. Basically, that has now been abandoned. And as they head into what's going to be probably a chaotic 4 weeks of tariffs and global disruption, both leaders position themselves as best able to handle that going forward.
So in the first few days of the campaign, where do both candidates stand?
Yes, Prime Minister Anthony Albanese's centre-left Labor Party has really clawed back a lot of ground from Peter Dutton's opposition. Before the election was declared, before the interest rate cut that we had in February, it was widely seen that Dutton was slightly ahead, that he could potentially form minority government after this election. However, since the campaign's begun, we've seen a big boost in Labor's vote. They're now leading Dutton 52% to 48% on a two-party preferred basis, which is potentially enough to win majority government in their own right if the seats form the right way, something that people were not considering just a few months ago. So it's been a good start for the Prime Minister, but 4 weeks is a long time in Australian politics, so we'll have to see where he is at the end.
Such a short campaign compared to other parts of the world, right? But Ben, as you said, a lot of these global issues, geopolitical issues have been dominating. What else are we watching out for in terms of the hot topics to be debated over the next 3 weeks?
Yes, well, I mean, the big one will be cost of living issues, essentially. So while the last election campaign had a lot of focus on things like climate action and Indigenous rights, this one is cost of living, cost of living, cost of living. And so we're seeing basically both parties pitching that they're the right group, they have the right suite of policies to take the pressure off Australians' hip pockets, more or less. The Labor government is offering increased funding for Medicare and then some small tax cuts to come in 2026, 2027, while the opposition is putting more emphasis on bringing more gas into the system to lower energy prices and a plan for a small cut to the fuel excise for 1 year if it wins power. So a very, down to a household's bottom line campaign compared to some of the rhetoric we've seen around the world.
Australia government reporter Ben Westcott there in Canberra. Well, let's bring in Felicity Deane, who's a professor of trade law at the Queensland University of Technology. Felicity, really great to have you with us. And it's been such unusual and interesting timing in terms of all of the global implications of the tariff war, the trade war, the secondary effects of what happens to China, and of course, Australia's exposure too. Do you think that's played into the gains that we've seen made by the government? Because we have seen sort of coming back against Trump's policies benefit other Liberal governments around the world.
Yes, good morning. And look, that's potentially true. Obviously, these are not popular policies that have been introduced by the United States administration. It could have quite a detrimental impact on the economy in Australia. There's going to be the direct impact, of course. We've been subject to a 10% baseline tariff, some exclusions, but they're reasonably minor. But the indirect impacts are largely unknown at this point, and they could be severe. So, very unpopular policy, and early on, I suppose, the Liberal Party did align with some of the US administration's policies to do with working from home and reducing public service, and this, of course, could have had an impact on the response of the Australian people to them.
We have heard quite a bit of commentary from Treasurer Jim Chalmers. Let's just take a listen in terms of his take on how this potentially affects Australia through these tariffs.
What we're seeing here is the impact of a series of bad decisions taken about tariffs, and the whole world is trying to get their head around the impacts on their own economies and the global economy as well. For Australia, there's really three channels that we are monitoring very closely. The overall impact on the global economy and global demand is obviously troubling.
And it seems like the most important of those channels is really the impact on the global economy, the impact on China, how that sort of blows back into demand for Australia, right? There doesn't seem to be overly a lot of concern over direct exports being tariffed to the US from Australia. Do you think that the government should have taken a stronger stance, given that they were one of the first governments to come out and say they won't be putting in place retaliatory tariffs?
Look, to be perfectly honest, I agree with that response. I don't think retaliatory tariffs would be a good response from the Australian government. And so Obviously, we know that tariffs are generally passed on to consumers, and it could cause short-term inflation here if that was done of any products that we import. And so it doesn't really seem to be sensible to impose retaliatory tariffs. So I agree with their responses to not negotiate on things like our biosecurity laws, though, and also our PBS was mentioned quite a bit leading up to the announcement, and both parties have indicated that neither one of these points are going to be points of negotiation.
So where do talks start? Because usually when you have trade disputes, you would go to the WTO, but we know that the Trump administration has largely sidelined the World Trade Organization.
Now, that is a very excellent question, and it's one that I've been thinking about quite a bit over the past few days, is what do we actually do from here? Because there are avenues, of course. Traditionally, international trade rules have really kept us on the straight and narrow. They've kept us very even ever since the conclusion of World War II. We've built up a degree of goodwill over this time because international trade, the rules are largely based there for people who believe that they can benefit from being part of the multilateral trading regime. Now, the United States doesn't seem to think that they do benefit from being a part of that, and so they have completely disregarded both the World Trade Organization rules, and it appears they've disregarded their free trade agreements. So the points of negotiation, I don't know where you start, because our legally binding agreements have been completely ignored.
Usually when we talk about these tariffs affecting trading partners of the United States, we are also perhaps giving some thought to these countries potentially veering towards doing more deals with China. But we know that Australia has had its own issues with Beijing. So where does it find its new markets?
Well, again, that's a very good question, and we don't know what the indirect impacts of these tariffs are going to be. Obviously, they are very widespread, and so they're going to impact on other countries, sometimes disproportionately to how they will impact on Australia, and this will impact on supply chains. In terms of finding new markets, I know this was something that the Albanese government announced would be part of their plan. And I suppose that just means working with the existing markets. We've obviously got trade agreements throughout Asia as well, and so these could be avenues.
We've talked about some of the major markets, and we have seen an increase shipments when it comes to agricultural exports to markets like China, like Japan. Unfortunately, a lot of these markets are also ones that are being targeted by the Trump administration with tariffs of their own. Are you concerned about diminishing consumer demand from those markets as a result of economic weakness?
Well, of course, there is that possibility. But if we're talking about our beef exports, for instance, then the demand for beef is increasing over time. So I don't think that's a huge concern in terms of those other markets. Our agricultural products are known to be some of the safest in the world due to our traceability schemes, which is also related to our biosecurity regime. And so I don't think there's a huge amount of concern about alternative markets for those products, or indeed whether the 10% is going to have a significant impact on the demand in the US.
Felicity, really great to have you with us. Felicity Deane, who's a professor at the Queensland University of Technology, talking trade and Australia. And we have more on Australia ahead every Tuesday. That's 11:40 a.m. if you're watching in Sydney, 8:40 a.m. if you're watching in Hong Kong. I should say that's actually 10:40 a.m. after the clocks have now changed here in Sydney. You can tune into the Bloomberg Australia podcast too. We delve into the biggest stories shaping the country's role in global business. You can find that on Apple, Spotify or Bloomberg.com. This is Bloomberg.
Take a look at how futures are holding up right now, as we've just heard from the PBOC in China that they will be providing re-lending support for Huijin investment. Of course, we have already seen news of these China sovereign wealth funds increasing ETF holdings in order to support the market. China Central Huijin had said that it had increased ETF holdings and that they will continue to do so in a statement earlier. Now we're hearing that the PBOC will be providing relending support for Huijin, that they have now vowed to defend the capital market stable operation, as we're now seeing some of these China state-backed funds planning to buy local stocks in order to support the market. Of course, not surprising given the immense pressure that we've seen already for Chinese markets plummeting in the previous session. Although right now we're seeing the A50 futures that have closed slightly to the upside of 2%. Other stories that we're following at the moment, JP Morgan CEO Jamie Dimon is urging a quick resolution to uncertainty sparked by President Trump's tariffs. He wrote in his annual shareholder letter that the quicker the issue is resolved, the better, as negative effects increase cumulatively over time and would be hard to reverse. Days after Trump won the U.S. election last year, Dimon said his tariff threats would get people to the table and that he hoped it would be done wisely. BlackRock's Larry Fink says most CEOs he talks to think the U.S. is already in a recession. Speaking at the Economic Club of New York, Fink added that he also foresees more of an economic slowdown in the coming months with elevated inflation and a weakening U.S. dollar. Despite the uncertainty, Fink believes that in the long run, the situation presents a buying opportunity.
Obviously, markets are down 20%. So some stocks are down over 30, 40% from their high water marks of just from January. But in the long run, I would say in the long run, this is more of a buying opportunity than a selling opportunity. That doesn't mean we can't fall another 20% from here too. But I do believe over the long run, the vitality of the United States will persist.
Time to check in on some of the stocks to watch when markets open in Hong Kong and in mainland China. We'll be watching Chinese internet and consumer stocks after the US-listed shares extended losses following Trump's threat to impose an additional 50% tariff on China. We'll also be watching Chinese suppliers of Apple as well. The Journal reporting that the tech giant plans to source more iPhones now from India. Let's take a look at how broader markets are travelling at the moment. We have seen that standout trade when it comes to Japan. That rebound really being driven by optimism over news that the US and Japan will hold trade talks. These will kick off after that Trump-Ishiba call there as well. But it'll be very interesting, of course, Shery, as we look to that response from Beijing.
Yeah, we are getting the latest comments coming from the Commerce Ministry that China strongly opposes the 50% additional tariffs. China is now urging the U.S. to immediately correct its wrong practices. China saying that they will fight to the end if the U.S. insists on these measures. They're vowing necessary actions in order to defend China's rights. They're urging to resolve disputes with the U.S. through dialogue, and China is now calling for more dialogue with Washington. That's it from the Asia Trade. The China Show is next. This is Bloomberg.